I see a lot of traders where they start cutting corners. Where's the trading plan? Where's the trade journal? Well, I had one and I stopped doing it because it got too cumbersome. Remember we talked about risk identification? Your trade journal is the number one source of identification of issues that you have in your execution of your plan. Well, if you stop doing that, it's a big source that you're giving up.
All right, welcome back everyone. Today we are sitting down with Michael Toma. I know I got a lot of requests about doing a video on risk management specifically, covering the topics of risk management in depth. And Michael here is a perfect guy to discuss that. He wrote the book called The Risk of Trading, talking about all the principles of risk management for traders, specifically how that applies to trading. I'm really excited to be chatting with him today. We'll kind of give you some overview of the risk management and the things you gotta know and gotta understand to be able to kind of get better at risk management in trading, in your Forex trading. So without further ado, let's just dive right in. And Michael, how's it going today?
Very good, very good. Hot topic these days with all the volatility in FX and the equities. Definitely a hot topic.
Yeah, for sure. So where do we even start in terms of risk management? A lot of people are going to say, oh, it's just about like the percent you risk per trade, just risk 1%, then you'll be good to go and you're pretty much done forever. Is this more complex than this? And I know for a fact that it is, but tell me, what else do we have to think about when we think about risk management in trading?
When you think about it, it's really not much more complex, but what it is you have to widen the scope when we talk about risk management and trading. Like you mentioned about stop losses or risk per trade, it's kind of, some nuances and kind of newbie in a sense. You want to widen the scope to more of a holistic approach to risk management, not just about individual trades. Where do I put my stop?
So tell me, what do we have to consider when you think of risk management? What's the first thing that comes to your mind in terms of managing the risk in trading?
Yeah, well, what it should be, and this is the most popular question I get when they send questions, to ask me like on a risk question. It's about where do I put my stop? What's my risk percentage per trade? Is it part of it? Sure it is. But what I want people to go, and this is a really good takeaway for our conversation, is take a wider picture of risk management. What is the things that are going to ruin your business, get you out, blow your account? What are the things that are going to prevent you from getting to the next level? This enterprise risk management, you can Google that term if you'd like, but it takes a much bigger scope and really focuses on the important thing. And to me, when it comes to risk management, the most important thing is keeping yourself alive, survival for the next day, and that's the concept of risk of ruin.
So what's the risk of ruin? Tell me more about kind of what that means for traders and what kind of risk of ruin should we aim for having in trading?
Yeah, it's a popular term these days, and you see it a lot on your trading platforms when you can do your key summary metrics, or if you're doing back testing. I like to keep it more simple rather than a textbook definition. Is what's the percentage that allows you to survive for another day? What's the basically chance of survival using the current strategies or implementation that you have in place? If you want to take a lot of risk and go for it on a account or something, you want to risk like 50% chance you're going to blow your account, but you're going to double your money in 2 weeks. Hey, have at it if that's your risk tolerance. But really, if we're going to survive in the long run here, we want our quote risk of ruin to be really less than 1%. I even want it less than 0.5%. The goal here is not to go and hit the home runs and double your account in a week. If you want to stay in this business, the most important thing is you're allowed to stay alive in this business. And that means cutting back on risk and reward, by the way, but it allows you to play for the next day. There's always another day in these markets.
I know you can find some of these calculators online in terms of like the risk of ruin. You can easily calculate that, but what kind of comes into a factor for that risk of ruin in your account? What are some things that you can influence as a trader to be able to reduce that risk of ruin?
Yeah, it's a great question. There's a few components, but here's the number one. Again, takeaway number two: size kills. Size, size, size. When we talk about blowing accounts, you look at these journals, and I'll do some reviews and say, how did I blow the account? If your size is small, and I'm talking about starting at the smallest of increments, it's nearly impossible, like 0.0001 risk of ruin, to blow an account. So we've solved that problem, right? You're going to be able to trade from the day no matter how bad you do, no matter how bad the markets treat you, and no matter how imperfect or non-compliant you are with your executing your trading plan. Size is the most important factor in reducing it. Most people think it's stop management, or my stop's too tight or too big of a stop. I'm going to blow my account. Not at all. It's all about keeping reasonable small size in relation to your account.
That, and I guess of course your win rate affects your risk is ruined. So if you have a strategy that has a higher win rate, you might be able to kind of reduce that risk a little bit because you have more winning trades coming in. But even then, it's about like how big your losses are. Your average reward to risk ratio, basically, in that case.
Yeah, yeah. And risk reward is linear too. I mean, you could have, a 5-to-1 risk reward, you're going to have a lower win percentage, but you could be very successful in this business with a 25% win rate. Of course, you have to have your risk reward in place. So that's all linear. It's kind of deceptive where most people think win rate is really the key to not blowing an account or, just having no opportunity to continue in this business. It's not necessarily the case. It's really about size.
So someone might have a really good risk of ruin, like they have a really small one. They might be very disciplined with their plan. Or let me just go back on that. So someone might have a really small risk of ruin. They might be really kind of good in terms of that, but they're still not able to trade profitably, or they are still kind of maybe having big losses. Can you tell me more about like the metrics we can look at to be able to identify how good a trader is or how bad a trader is in that case? What are some of these metrics, these terms we can kind of think about to evaluate anyone's performance in trading?
Yeah, it's great. And this is really getting back to the enterprise risk management concept that I mentioned earlier. It's looking at identifying, and really the core principles of risk management is the identification, the assessment, and what we're going to do about it, the control of what we identify that could be a problem. When we're identifying some of the things that could go wrong, is it your execution of your plan? Is it compliant, so to speak, in the sense of your plan? Does it have a strategy that has a consistent edge, generally speaking, in all markets or most markets for a reasonable sample size, sample period of time? If that is the case, you should be just executing. And if you're executing properly, you should be on your way. If not, there's flaws. And that's what we encourage people to have, not just a trading plan, but a development plan. What are those things that were identified? And it may need a coach to help you out with that. What are the things that you identified that's preventing you? What's the problem? Why is your risk of ruin high? Maybe it's size. Maybe it's just your strategy. Maybe it's a good strategy. Maybe you picked it up somewhere and people are doing well with it, but it's not comfortable for you and you're not executing it well. These are the things in the identification process that brings to light what's the problem, what's stopping you getting from where you are, where do you want to go.
So what are these metrics we can use to evaluate your performance? What are some of your favorite ones in terms of metrics and like statistics to look at?
Yeah, my favorite one is trade compliance. I mean, as traders, we are executing a plan. So the biggest metrics I want to see as a coach, as an auditor, and really as a trader is how effective am I executing that plan? Think about it. Let's really simplify this. If you have a strategy and you have a plan with a good risk management plan that creates edge over time, by definition on paper, you will be successful. Again, there'll be drawdowns and little quirks in the market. That's the beauty of the markets and randomness. But you will have that. So really the key is, how am I executing that plan? How effectively am I doing it? And if I'm not, those are the things I want to identify. So plan compliance, big one, big one. The other thing, and a lot of people have this on their platforms as far as their summary metrics, is the profit factor. We talked about, does your strategy have an edge, or does how you execute it have an edge? The profit factor will identify that. Anything over 1.0. So if you have a 1.3, 2.0, something like that, that means the strategy is effective. Now all you have to do is execute it. So the profit factor is another thing I look at to say, okay, wait, before we look at, are you making any mistakes? Do you have a strategy that has an edge? Most important. Then we'll move to the compliance part.
Tell me about the risk, because one thing is like having stats that make sense, and a lot of people are chasing like the best stats possible, the best like profit factor, or the best. Of course, like compliance level is good, but let's just say the best profit factor. What if you get like a 5 or 6 profit factor? Is it because people I think it's a good thing, but I think you're putting yourself at risk of losing more if you have actually a really 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 good metric in that case.
Yeah, exactly. A lot of traders come to me and they'll ask me to do an audit. When I see like 4 or 5.0 profit factor, scares the hell out of me, to be honest with you. And it really raises a lot of red flags. It shows me that this strategy, based on the back test, maybe it's small or even maybe it's too wide. There's something going on there. There's too much risk being taken. It doesn't have the longevity, sustainability to again, for the long-term type growth as a trader that we're looking for, a trader's looking for, or even, if you want to trade prop money or hedge fund money. I like to see that sweet spot. that 1.30, 1.75, maybe even scrape a 2 here and there. That's fine. Once I start seeing 2.5, 3.0, you get nervous. So again, everybody's looking for that bigger number. Not the case at all. You want that sweet spot, get the most meat off the bone, but more importantly, get that meat off the bone consistently. That's the key to success in this game.
I know that we've been talking a lot about risk management for like a prop firm aspect, being able to pass a prop firm challenge, getting funded. We say risk management is really key in that area, and it's definitely true. But what are some things that kind of come into when you want to trade for a prop firm that might not think about if you trade only for yourself and try to just kind of understand the basics of risk management? What are some of the advanced concepts that apply to prop firms specifically?
I've been on both sides of that. I mean, you're a trader, but also I'm the risk guy who taps the trader on the shoulder saying, can't do that, can't do that. And so, here's a few things you have to do. One, prop firms, what they really want to see is they don't want to see the home run. They get scared too. They have risk managers on staff as well. They want to see that consistent equity curve, slow, steady, profitable grind with some drawdowns. Of course, that's normal. See that good, solid equity curve. The other thing too, particularly in when you're taking a prop challenge, well, first of all, just look at any of the prop firms and you look at their parameters online. The first thing you'll see is a whole slew of things about risk management, what you can do, what you can't do, and what they require and really what they're looking for. And quite honestly, once you get funded, the fun just begins. Your goal here is not to just manage a $25,000 account. You want to grow that. And you're going to do that by solid risk management. How do you do it? Solid equity curve, following a plan, being compliant with the risk metrics, right? And understand that, it's a challenge. It's a 30-day or a 6-month. There's a little bit of a gamemanship to it, but really don't switch your strategy. We've seen a lot where when people switch their strategy or they get frustrated mid-session in a challenge, it virtually has a 0% success rate. And even if you get lucky, you're not getting past the second level. Your account will tell you, or your risk manager will tell you, not going to happen. So stick to the strategy, stick to the plan.
I've spoken to a lot of traders in the past that understand like they're gonna have drawdowns, but the thing is, especially with the prop firm, they don't want to lose the capital they've earned with that prop firm. So they have, let's say, a 50K account. They don't want to lose it with like just one drawdown by hitting the top bracket of the limit of drawdown. So what are some things you can do in terms of risk management to prevent that from happening? To make a drawdown happen, of course, and kind of live with it, but not make it too big where they are going to hit the target, which sometimes can be quite small too. Like these targets are not huge. So what can they do to be able to have a drawdown but still recover from it within the prop firm?
Yeah, well, first thing, again, we'll get back to the same core principles of enterprise risk management. Size, size, size. Size kills. So keep that size reasonable. Err to the side of smaller. You could always grow it as you progress. But really, what you also want to think about is, again, trading your plan effectively. So, look for that compliance rate, compliance factor. If you're doing all those things right, and also, by the way, I'll throw in there, what does your back test tell you about your drawdowns? What is your average drawdown, say, over a 3 or 4 or 5 year period, right? Look at that as your benchmark and assume the worst will happen. I personally like to even double the worst. So put yourself in a scenario as, okay, if my biggest drawdown was, say, 8%, let me put on my challenge saying, all right, I will have a 16% drawdown sometime in my challenge. What's the parameters? What's the size that I need to put on to overcome that and allow the time to overcome double the size, maybe 1.5 times? So what is your back test telling you? And then manage that accordingly, assuming the same thing will happen, unfortunately, during your challenge.
That's a good way of putting it. Like maybe discouraging for some traders who expect for the best but didn't plan for it. But it's a good way to look at it for sure. The other thing I was going to ask you is like, what are some things people can do to be able to ensure the strategy they have now will work for a prop firm?
Yeah, well, just like any sort of job per se, you have to bring your resume, and not I'm saying the physical thing on the paper. What do you have to offer the prop firm? The prop firm wants traders. They have capital. They want traders. It's good for the diversification of their assets, right? Especially something unique and special. What makes you special? What can you bring to the table? To me, one, if you can come to a prop firm and you'll probably meet with the risk manager, they'll say, show me your equity curve, okay? And show me you can execute a plan. Show me plan compliance. I mean, we've spoken to people on the podcast itself, prop managers, they really not even that concerned if they're maybe not profitable. But if they can execute a plan properly, says, well, we're really interested. Think about that. You would think they're just like, give me the guys with the, fire who has the biggest home runs. Not the case at all. They want to protect their assets. They want to protect their portfolio. And they want a trader who's going to bring to the table consistency and one that's not going to keep the risk manager up all night long.
And I think it's also about understanding your metrics. Like you mentioned, you draw down on things, and then from there you kind of try to kind of fit it in with the risk per trade to the prop firm rules. But I think the biggest thing is like people not understanding their stats. They don't have any data under their stats, like you mentioned, the profit factor. They don't know what their compliance level is in the past based on the execution. And from there, it makes it really tough to be able to kind of trade for a prop firm because you don't know what to expect, basically. And that's really stressful.
Yeah. And whose fault is that? I mean, sometimes, it's just an education part. And maybe, it takes coaches or people like us to kind of handle that part for them, like as a third party. That's fine. But, I see a lot of traders, they start cutting corners. Where's the trading plan? Where's the trade journal? Well, I had one and I stopped doing it because it got too cumbersome. The trade journal is remember we talked about risk identification? Your trade journal is the number one source of identification of issues that you have in your execution of your plan, right? Well, if you stop doing that, it's a big source that you're giving up. So, is this the markets just having a crazy month? Is it maybe just, some of the pairs just went out of control? Or maybe look in the mirror and say, what can I do to help me? This is all about enterprise risk management. This isn't about just, self-improvement. This is all part of your business plan that are going to get you to success. And the ones that cut the corners, really we've seen, don't make it.
Are there any other topics you want to discuss that are you think important for traders to understand in terms of risk management? Anything else that you feel like you want to mention to people here that they have to be able to follow and understand?
Yeah, a couple of things. I mean, glad you brought this up. I've noticed lately, especially with the high volatility, a lot of traders are sort of maybe drifting to other markets. Like, wow, the equity markets are really flying, and FX traders are also like starting to trade gold and oil. I see in their trade journals. I go, I don't remember that being a part of their trading plan. I mean, I want traders, as far as the development, to open their eyes to different product, be product indifferent. But there's a development to that, right? The other thing too is I want to bring up is, especially with some of these high flyers in the FX markets, think about correlation risk. Again, part of your risk management plan. Do you have too much USD on? Do you have 2 or 3 pairs and they're all JPY based? That can affect, even if you trade small, now you have multiplying 2 or 3 pairs on at the same time. Now all of a sudden, visually it looks small, but no, you have too much size on. Correlation risk is something I really want to bring to the table, make sure everyone's aware of when they're putting on size and trades.
It might be a question that's kind of strange and basic, but for the people who don't know this yet, what are some things you can do to understand whether there's a correlation between the pairs or not? Is it just based on, like especially in Forex, is it just based on the currency that you use, or is it based on the actual results of trades, how they behave? What do you use to kind of look at the correlation between two assets in the market?
Yeah, I mean, you look at some of the big pairs, USD, JPYs. They, if you have too much on or more than one position on in one of those, by definition, you at least want to be aware, what is my correlation risk? And we have for in our academy, most of them get online, sort of correlation kind of graphs and comparisons to see like what pairs have the highest correlation. But you want to look at the nuances too, particularly in things like, say, the Aussie dollar, which is very sensitive to prices in precious metal movements like gold, and the oil markets with CAD. So look at those things too. When you're trading CAD or the Aussie, you should have be aware of what's going on in gold markets, what's going on in the oil market. So correlation isn't just about what do I have on and my trading same pairs. These are little things, again, part of the development of an FX trader, but very important to reduce overall portfolio risk to your journey.
Now, you would think that also part of risk management is being aware of all the fundamentals and news coming up. You don't really use those in your trading yourself. So why is that important that much for you in terms of like knowing which news is coming up, which things are going to happen, how the fundamentals look? Why isn't that important for you?
Primarily because over a long series of sample size, if I have an overall edge in a strategy, I'm just going to trade the opportunities. I'm going to be very news indifferent. However, One, if you're taking a challenge, you may have some certain restrictions as far as the actual prop firm may have. But there's certainly increased the volatility, and you need to be aware of that and what your results are by doing it. For the most part, a lot of the news that comes out normalizes over the next few days, particularly in equity markets, and also I've seen in FX. So there really is an opportunity there. But some traders look at this as like a candy store, and it's like, oh, news. I can, they look at the reward, potential reward. I can get 5R on this. Yeah, but again, focus on the risk. The rewards will take care of themselves. So, if you wanted to take a step aside, that's fine. Trading news and surrounding yourself by news definitely increases the risk level. It also increases the reward. But again, focus on the risk for now. Trade for another day.
Good points there, Michael. And that's one of the reasons why I'm really proud to have you teach our ultimate platform trading program that we are using to teach people how to get funded by prop firms and then scale up their trading. I think that's a huge asset to have someone like you knowing risk management, like by heart, all these topics, be able to coach traders on passing these prop firms. So you want to talk a little bit more about what you do in that program, and then you can introduce yourself to how that would work out if people want to learn more about that program.
My role basically is to make sure they keep in line with the risk principles that are required to make sure you're successful in achieving whether it's prop money or outside capital or whatever the case. But of course, it goes into general coaching features as well. So basically, we're a support team. I play a big role in really one-on-one hand holding some of those, whether it's new traders or just experience that just seems to losing its edge or not getting to where they want to go. Really just to kickstart and really help them, again, like we talked about in risk management, identify what are the immobilizers that's preventing you from getting there. We'll identify them, we'll put action plans to them. And again, successful traders really don't do anything much better than, say, traders that are struggling, except eliminate their mistakes. They don't trade more, they don't trade, usually bigger size proportionally. It's just they eliminate the mistakes. So that's our role. Eliminate those mistakes, and all of a sudden, the light starts to shine, and next thing you know, they're starting passing phases of challenges, and then it kind of allows them to be more flexible and say, okay, what do I want to do with my career? The door is open now. So we're there to identify and eliminate those kind of mistakes, sometimes newbie, sometimes professional, and their own personal demons to get them to where they want to go.
That's a pretty cool way of putting it for sure. And I think we'll leave some links below for that in the description below. Hey, so just a quick thing here before we finish off this video. If you want to see more topics on risk management, you want us to go in depth into those topics that can help with your trading, make sure you comment below in the comment section. I will be going through the comment. I'll be reading what you think, what you like, what you want to see more of. And then we can cover these topics more in depth. I think these will be pretty cool to cover. Again, not the most sexy topics to cover. For sure, risk management is a fairly boring but yet powerful topic that a lot of people are overlooking by a big time. So a big thank you to Michael for doing this video with me. And we'll catch you back here in the next video pretty soon. Ciao.